Hello, everyone, and welcome to Numera Analytics online briefing entitled, Is the U.S. Reign Coming to an End? I'd like to welcome Joaquin Critzlara, our head strategist at Numera, and Tomasa Marinozzi, economist at Numera. Welcome, guys.
Thank you, Chris.
Guys, we're now into our 11th year of U.S. equity outperformance over the rest of the world. History has shown that the length of this outperformance is long in the tooth. To support this, you can argue that European equities seem cheap. Japan seems to be coming out of a 30-year hibernation. And you know that China will throw everything but the kitchen sink to make sure growth continues. So why not a reversal now? Lots of questions to answer. I'm going to hand it off to the two of you, and hope we can answer as many as possible.
Absolutely. All right, Chris. So I'm going to get started. Just to sort of illustrate this point you're making, I think it's important to sort of see what you were describing visually as a first instance. What you see in front of you here is a comparison. It basically, the green line here tracks the relative performance of the S&P 500 against offshore equity investments. So developed markets excluding the US, obviously heavily weighted towards Europe and Japan. And what you can see is essentially overweighing the US versus international stocks in the last decade, or really since the aftermath of the 2008 financial crisis, has been essentially a one-way bet. Now, the red line overlaps the relative performance of the US economy against other G7 countries. And you can, I think, make a strong case that part of the outperformance that the US has had on a trend basis is linked to productivity differentials. The US is an economy that grows more than certainly than Europe and Japan, and that obviously helps improve the premium or on US assets relative to those of the rest of the world. Now, you could make a stronger case, as you see here, for overweighing the US after the financial crisis when it looked cheap relative to macro fundamentals. As of the last 5 or 7 years, that argument has weakened, with the US probably growing considerably more than you could just justify based purely on growth differential. So before sort of discussing the outlook, I think it's important to understand what are sort of the reasons why we've seen this outperformance, especially in the last 5 years. So one way to do so, this is a chart that we usually like to update. What this basically shows you is a breakdown of the performance of, in this case, DMX US or offshore stocks against the S&P in the last 5 years, but broken down by source of return. So if you look at developed markets as a whole, on average, international stocks have trailed investments on the S&P by about 7% per year, that's a big number. And what the bars then break down is the relative contribution of earnings differentials, valuations differentials, dividend differentials, and the FX swing in explaining that spread. So in every case, so across all major economies, we've seen a weak relative performance. You know, in the case of Japan and the UK, you know, these markets have trailed the S&P by, you know, more than 8% per year on average. But even for other economies, for small open economies like Australia and Canada, the underperformance is very significant. If you focus on the dark green bars, much of that underperformance is explained by earnings differentials. Now, I showed you before that the US has grown more than other developed markets. This also has to do with sort of equity composition. The US is much more heavily focused on technology than other developed market stocks, which are essentially value cyclical stocks. And the tech space, above and beyond benefiting from more multiples expansion in general, it also has stronger earnings growth. especially things like software, for example. So these are segments that have grown faster than old economy sectors in the last 5 years, benefiting from a lot of liquidity. And that has explained the outperformance. And then another big factor at play has been the persistent rise in the US dollar, which, as you can see, strengthened against every other reserve currency in the last 5 years, and so therefore weakened the relative appeal of overseas investments, or unhedged investments at least, right? So basically, for the US, for this dynamic to reverse itself, let's say in the next 2 years, what you would likely have to see is a situation where earnings growth in the US becomes considerably weaker than that of other developed markets, or alternatively, that the dollar were to weaken persistently, which is something that's being discussed quite a bit now, right? This idea that the dollar may lose its status as the preeminent reserve currency. So basically, the discussion is one where you need to both understand US dynamics and offshore dynamics simultaneously. Starting off with our views on the US, the market has performed quite strongly this year. If we were to take a step back to see to the start of the year, there was quite a bit of pessimism around the equity outlook, and that really stemmed from two forces, which actually materialized. One was fears that the economy was going to slow down, and then the second one was that high borrowing costs and the Fed hiking cycle was going to continue compressing valuations as it did in 2022 and potentially even drag on earnings. What you see in front of you is a breakdown of the performance of the S&P adjusted for inflation during the first 5 months of the year, but broken down by the contribution of various macro factors, right? So this is a little different from breaking it down by source of returns, because Fed policy, for example, affects both earnings and valuation. So what we do is we decompose the causal contribution, as best as we can possibly estimate that, of various macro shocks to observe changes in asset prices, in this case the S&P. And so what we find by doing this exercise is that growth expectations and Fed policy have actually been quite a drag to equity returns in the US, reducing returns by more than 10% on a combined basis. It just so happens that that has been more than offset by three factors. One is the fact that the dollar weakened a little bit, improving the upside for sectors that are heavily export oriented or that derive a lot of earnings from overseas investments, like industrials, for example. But in addition to that, I think there are, our research reveals there's basically two big factors at play. One is that there are the market perception of credit default and liquidity risk is very low. So that's what we would call financial stress. And you can look at that by focusing, for example, on credit spreads, that they're incredibly narrow right now. And so there's this perception that, even if you were to get a slowdown, the likelihood of you getting defaults is very limited. And then on top of that, returns have been amplified by essentially enthusiasm around artificial intelligence. Remember that, again, because the US market is heavily tilted towards tech, optimism around AI has channeled a lot of funds into the US equity market, and particularly tech stocks, starting in December from the launch of ChatGPT. And again, because this is a disruptive technology, regardless of whether you think this is going to have a big or a small impact on productivity growth long term, it is by definition speculative in nature, because we don't really know what the effect is going to be long term. But basically, those are the two big sources of support. Now, I think you can make an argument that as long as interest in AI remains strong, there is some momentum that you can expect for the S&P and the NASDAQ, for example, right? So tech sectors stand to benefit from further increases in fund flows to the extent that interest in AI remains strong. The problem is that the market is still very vulnerable to negative growth shocks. So what you see in front of you here is our 12-month projections for real earnings on the S&P 500. This is our updated forecast. So the way to read this is as follows. What we do in Numera is we look at the full distribution, right? We don't just focus on baseline scenarios. For any of you who follow our research, you've seen charts like this throughout our research. So we're interested in monitoring the full range of potential outcomes and then the likelihood of certain scenarios materializing. So the most likely outcome based on what our research is pointing out right now is for a contraction in earnings of about 2.5% over the next 12 months. That by itself is not a particularly favorable outcome. On average, the US or the S&P posts real earnings growth of about 5% per year. It's not impossible for that to happen, but what we find is essentially a 1 in 5 chance of that materializing. And then if you focus on the very left tail of the distribution, what you see is that we can't discard a situation where earnings were to contract, say, between 20 and 30%. Those would be scenarios associated to deep recessions, right? And above and beyond rising borrowing costs, one of the key things that's happening here is that we're picking up, this idea that financial markets are underestimating default risk. If you look at lending surveys, for example, banks have started to tighten lending standards quite significantly, not just because there's weak demand for loans, especially for industrial and commercial loans, including commercial real estate loans, but because they're concerned about credit quality. And that is a strong signal that you could end up in a situation where growth were to weaken considerably within the next 12 months. And so the earnings outlook doesn't look great. The one thing that does support the US equity outlook in particular, I would say, is that valuations should benefit from lower long-term interest rates. Remember last year, the big drag on yields, on returns on stocks was a sharp increase in long-term interest rates owing to higher inflation and Fed tightening. We expect this to partly reverse. What you see here is our updated forecast for the 10-year US Treasury yield. The yellow line is our January projection, and the red line is what we expect, is what our baseline scenario looks at the moment. We've downgraded our view on long-term yields relative to what we were expecting earlier this year. Obviously, if you focus on what the Fed is saying right now, is they're claiming that they're going to hike rates at least 2 more times. Powell spoke this week at the ECB conference in Sintra, saying that he would not discard multiple hikes between now and the end of the year. We think that this is certainly a possible outcome, but we're picking up 2 things that we believe the market is underestimating. One is that while we were earlier in the cycle expecting very high inflation and persistently high inflation, there are now signs that either through an easing of supply chain disruptions or falling housing prices that should eventually translate into lower rental prices, there's a high probability of observing negative inflation surprises in the second half of the year. And to the extent we get that, then the incentive to continue hiking becomes lower. Beyond that, if the economy were to weaken, you would get flight to safety effects, and that would compress long-term yields, which again is bad for earnings, but provides some support in terms of valuation, especially for the S&P that's very tech focused, right? And so when you piece this together, our overall outlook for the S&P is one where we'll likely get below trend, but still positive real returns on stocks. And so when you think about what will happen to the rest of the world, as I was saying before, offshore stocks are essentially value cyclical stocks, meaning that there's very little IT, let's say, outside of the US. There's a much bigger prevalence of things like industrials or consumer stocks, especially in places like Europe. You also have an exposure to raw materials like in Canada and Australia. But basically what this means is that the upside on investments outside of the US is very strongly linked to growth prospects. What you see here is our latest projections for growth in developed markets this year. The red dots are the market consensus, and then the bars are base scenarios for growth across developed market economies. So as you can see, in essentially every case, we're expecting negative growth surprises or a high probability of negative growth surprises towards the second half of the year, basically because it takes time for rising interest rates and high borrowing costs to actually hit the real economy, and we're only really in the early innings of this. In Europe, for example, we're starting to see evidence of this in the manufacturing sector. For example, manufacturing orders in Germany, if you've been following this, have been falling very sharply in recent months. And again, this is probably the first sign that tightening that tight monetary policy will start having a drag on activity. And so the point is that to the extent that you get these negative growth surprises, for which we find a high probability, then the upside on investments in developed markets is rather limited. Specifically with regards to Europe, Europe has been, it's performed extremely well in the last 9 months. If you do a drivers decomposition, kind of like what I did for the US, what you find is that the bulk of the improvement stems from lower systemic risks, basically as Europe has built resiliency to the Russia-Ukraine war, say through the buildup of regasification capacity. That's allowed systemic risks to decline considerably, and it's fueled risk assets. But again, the support from this has probably peaked, and so moving forward, the outlook will depend on growth prospects for the euro area, which are not great, and it'll also depend on ECB policy. The ECB, again, if you've been following the meetings in Portugal this week, have hardened their stance very significantly in recent months. Lagarde yesterday, for example, said that the only objective that they have at the moment is to bring inflation down to 2%. And so irrespective of the consequences, right? So to them right now, there's no trade-off. It's just focusing on inflation. And so when you think about ECB policy, you really have to think about the inflation outlook. It is true that goods inflation in Europe is dissipating, and that easing of supply chain disruption should allow goods inflation to decelerate. The key problem here for Europe is the structure of the job market. What you see in front of you here is a comparison between core inflation in the euro area against hourly wage growth. So this is actually for the 4 largest markets in Europe. So this would be Germany, France, Italy, and Spain. Now, what you can see here, and this is very much in contrast to the US, in Europe, core inflation leads hourly wage growth by about 6 months. And this seems strange conceptually, right? So typically the way we think about the impact of, or the relationship between wages and inflation, is that wages are essentially a cost push factor, where in labor intensive sectors, if you observe higher wage growth, assuming the demand conditions are strong enough, that those get passed on onto higher prices, that creates inflation. In Europe, the reverse is true, where inflation leads wage growth. And the reason why this is the case is because, unlike the US, where about 10% of the workforce is under collective bargaining agreements, in Europe, that number is about 80%. So that means that 80% of Europe's employed population, again, falls under collective bargaining agreements, which basically creates inflation persistence. As unions observe higher inflation, they try and push for higher wages, which itself creates more inflation and creates a wage price spiral. And that's exactly what we're seeing in Europe, where basically the dynamic has gone vertical. We haven't seen this dynamic really in the last 2 decades or so, basically because inflation has been really weak. But now the situation is such that in order to break the cycle, the ECB has really got to turn very hawkish. And so the possibility of the ECB keeping rates high for a long time is very strong, certainly relative to what markets expect. If you look at, say, the Euribor futures curve, for example, markets are pricing declines in ECB policy rates towards the second half of the year. The chances of that happening are very low. And so there is a risk that this will endanger valuations and therefore make Eurozone assets even less appealing. When investing outside of the US, obviously the currency outlook matters enormously. We do think that the ECB will keep rates higher for longer than the Fed, and so that would cause interest rate spreads to widen in favor of Europe, like they have been doing so in the last 6 months. And so typically, when you have a widening interest rate spread in favor of Europe, that would typically cause the euro to strengthen in value. You can see this here. The green line compares the year-on-year change between the euro to dollar exchange rate. So if the line is falling, then that means that then that means that the euro appreciates, and if the line is rising, then that means that the euro depreciates. The blue line in turn tracks interest rate spreads. So basically what we've seen recently is interest rate spreads have widened in favor of Europe, right, as the ECB started raising rates aggressively in the second half of last year, and that supported the euro and therefore amplified returns on Eurozone investments in dollar terms, right? And so usually this is the case. The problem is that when you get negative growth for prices on a global basis, the dollar is more of a reserve currency than the euro, and so this dynamic doesn't really apply. We saw that in 2008, 2009, which is the shaded gray area. Remember that at the time, the Fed started lowering rates much faster than the ECB. The ECB kept rates steady until 2009, whereas the Fed started cutting in after the Bear Stearns collapse in 2007. And yet, over this period, we had the dollar strengthen in value. And so to the extent that you get these negative growth for prices worldwide, there is a high probability that the dollar will strengthen against the euro, regardless of what happens to ECB policy relative to Fed policy, right? And so when you map this into what it means for investments in Europe, it actually doesn't, it's not a positive in the same way that it has been in the last 6 months. Where we do find alpha potential, I would say, in diversifying offshore is in Japan. There's various reasons for this. There's been quite a bit of interest in Japan recently. Portfolio inflows into Japan rose quite a bit in the second quarter of this year, to a large extent because of a shift in corporate policy by Japanese public companies, focusing more on dividend issuance and stock buybacks. This is something that has been encouraged by the Tokyo Stock Exchange, and that has triggered a lot of inflows. Historically, Japan does less share buybacks and less dividend issuance than the rest of the world, and so they start doing more of this, and that has encouraged interest in Japan. Moving forward, though, we see a variety of factors that should support Japan, especially relative to investments in other developed markets outside of the US. For example, what you see here is a comparison between the relative performance of Japanese against Eurozone stocks, that's the green line, this is in deviations from trend, to facilitate the comparison. And then the red line does the same thing, only comparing real money supply, both in Japan and the Eurozone. Now, the BOJ is the only central bank in the world, at least in the developed world, that maintains a very dovish stance. They have yield curve control at play. They haven't really, started quantitative tightening in any significant way. And that contrasts to the ECB, who are now adopting a really hawkish stance. So while the credit impulse in Europe has turned really negative, this is not really the case in Japan. And so that greater liquidity support in Japan should both favor growth in Japan. Japan is really the only country across the developed world for which we see similar growth prospects than what the market is pricing. Whereas in Europe, we expect deep negative growth for prices. And so the earnings differential is very much favorable towards Japan relative to Europe. And then valuations also stand to gain from the fact that the BOJ is unlikely to pivot. Inflation is obviously now above target in Japan, but unlike the rest of the developed world, Japan is a country that wants inflation. And so the incentive for them to pivot is much lower than that for other developed markets, including Europe. And so in this context, we find a very high probability that local currency returns in Japan will outperform those in the Eurozone. Again, the outlook here really depends on the foreign exchange swing. So in this case, the outlook between the yen and the euro. This chart, I think, illustrates this idea well. This is, again, a probability forecast, in this case, comparing the relative performance of Japanese against Eurozone stocks. So this is the Japan against the EMU MSCI index, 12 months into the future. But what the two distributions do is they break down two scenarios. The blue line focuses on scenarios in which the yen appreciates against the euro, and then the green line focuses on scenarios in which the yen depreciates versus the euro. And if you focus on the blue one, to the extent that the yen were to appreciate, the probability of outperformance of Japan versus Europe is very high. It's about 82%, with expected excess returns of 13%. Now, if the yen were to depreciate against the euro, that probability drops sharply from 82 to 37, because again, beyond the direct effect of a stronger euro supporting investments in Europe relative to those of Japan, a stronger euro is associated to stronger growth prospects in Europe, and therefore that would also support local currency returns. Now, if you look at the actual probability of the yen appreciating against the euro, it's high. It's about 70%. And the reason for this is, again, because we expect weak global growth, flight to safety effects should support the yen, which is already trading at a discount. And so when you take, say, a weighted average of these two scenarios, it reveals a very high probability, roughly a 2 in 3 chance that Japan will outperform the euro area. So when thinking about investments outside of the US, while we don't necessarily think that you should be overweighing DMX US as a whole, we do find some opportunities, particularly in Japan, relative to other big regions such as Western Europe. And just to finish off my section, just briefly to present this idea that Tomas will now expand on, which is, we're not particularly optimistic about the rest of the developed world. We do see opportunities in diversifying towards emerging markets. In general, we find that emerging market stocks today offer a much better risk-reward trade-off than developed markets. And this is, in fact, different to what we've seen in the last 5 years, when emerging markets have essentially consistently underperformed DMs, including certainly the US. So the way to read this chart is as follows. This is a standard chart featured in our reports. This is basically a comparison of upside against downside risk across asset classes. It's sort of like a Sharpe ratio comparison. The big difference here is that we define upside risk as the probability of positive returns, or basically of you making money on an investment, by the expected gain on that investment. And then downside risk is the likelihood of you losing money times the expected loss. So it then makes sense that what you're looking for in sort of long-only portfolios is assets that have a high upside and low downside, and then you want to underweight assets with a low upside and high downside. And so the numbers that you see here in red basically rank the assets by this risk-reward trade-off. So assets that have high upside relative to downside are more attractive. Now, in blue, we have your developed market stocks, and then in green, emerging market stocks. Obviously, emerging market stocks are riskier. They're high beta assets. And so, there is obviously always a greater risk in investing in emerging market assets, if only because the FX swing is very large and they're exposed to shifts in portfolio flows. But the upside today is proportionately higher, right? More than compensating the fact that they are riskier investments. And so in general, regardless of the region, you look at Latin America, EMEA, or Asia, the risk-reward profile is in general more attractive than it is for developed markets, particularly for the Eurozone, but even if you notice, also relative to Japan and the US. Now, there's various reasons why this is the case, and so I'm going to hand it over to Tomas now so that he can expand on why we're now recommending overweight positions on emerging market assets, at least in the next 12 months.
Thank you, Joaquin. I'm going to try to be as brief as possible so that we don't take too much of the time. But yes, my task is to sort of explain why we think emerging markets are an interesting diversified to developed markets. But in order to do that, we have to take sort of a step back and recognize why emerging markets haven't performed as well as developed markets so far this year. So what we're showing here is similar to other charts that Joaquin has shown recently. We're doing a drivers composition of emerging markets MSCI index in US dollars, and then we deflate it by inflation, American inflation. What you notice is that in the first 5 months, emerging markets returns in emerging markets have been pretty much flat over the first 5 months, despite the rebound in Chinese activity. And the way we interpret this is, even if Chinese growth, or at least Chinese activity, was a positive factor in the first 5 months, it was offset by falling commodity prices and weaker terms of trade, and also monetary policy drag from emerging markets. Like in the case for Latin America, they had a very extensive and hard hiking cycle. Then if you take Asia outside of China, you also see important hikes there that was also offsetting equities. There is some sort of effect from DM risk, given that there was some diversification towards emerging markets after the Silicon Valley crisis and then the Credit Suisse event in Europe. But overall, we do see that the drag was mostly driven by monetary policy and terms of trade. Moving forward, I think investors are also concerned with the fact that China's activity is decelerating and momentum is fading. The way we want to illustrate this is by showing mobility and activity together. We know that since 2020, mobility and activity is very linked, particularly for China. So what we're showing here is subway traffic as a proxy of mobility, and then we're showing our own proprietary indicator for high frequency activity in China. And what you notice is that in Q1, after the lockdowns, activity has recovered dramatically in China. But then in the second part of the year, and the second part of the Q2, basically, subway traffic was pretty much normalized, but then activity is decelerating. Now, this is bringing concerns to investors, and there's a point to that. Maybe what we are going to discuss in future slides is whether the government would allow this to continue, or if they will improve by expanding in fiscal stimulus. But if we take a step back and we think, even in this context, is it worth it investing in developed markets? Or probably not, because of the reasons Joaquin just mentioned. There's adverse macro context that we think, and this is particularly focused on developed markets. So what we're showing here is the performance of emerging markets in diverse macro context for DMs. So basically, we're showing either DM stagflations on the horizontal axis and DM recessions on the vertical axis, and then we're showing historical returns for different assets, both EM bonds and stocks, and DM bonds and DM bonds. And what we notice is that in adverse macro scenarios for developed markets, emerging markets tend to outperform. The reason for this, we think there's two reasons. One of it is because we perceive these adverse macro environments for DMs to be transitory in nature, meaning that investors understand that there's an opportunity, a temporary opportunity to rotate away from DMs when the macro environment is not good. They go towards EM stocks and EM bonds. And then once the economy stabilizes in developed markets, they switch back towards DMs. But that creates a temporary opportunity for emerging markets. And the second reason why this tends to happen is because the crisis for the EMs usually are not focused on EMs as well. If the crisis was derived as a world crisis or particularly a EM crisis, then the story would be very different. Like, for example, the case of the crisis in Asia in the late 90s, that's a very different scenario for emerging market stocks than what we're seeing now. But because, as Joaquin mentioned, we're thinking that this is going to be a negative growth surprise, mostly focused on DMs, we think there's an interesting opportunity to diversify towards emerging markets. Now, I was mentioning before that the deceleration in China is a big concern for investors, and it's true. But Chris also mentioned, and he made a fair point, that it's unlikely that the government will let this continue. At least they're going to do as much as possible to revert the situation. And that's sort of what we've been seeing so far. Now, in August 2020, the government implemented the 3 red lines, which are basically financial regulatory guidelines that they relate to the ratio of debt to cash, equity, and other assets. And that was detrimental towards real estate investments, as we all know. But what we've seen so far is extensive government support. To reflect that, what we're showing here is real estate investments and money supply year on year. And obviously, money supply has a 6-month leading effect towards real estate investments. And what we've noticed is that lately, the government has put a lot of effort into both monetary but also fiscal stimulus to revert the situation in the real estate investment, and it hasn't kicked in yet. Now, we don't think that the real estate will recover as much as it was in the past, but it's possible that you're going to see at least a rebound, an interesting rebound in the second half of this year and perhaps part of 2024, which again, it makes interesting for emerging market equities and Chinese equities. And what we're showing here is that an effect of 10% increase in building activity will have positive effects in China, of course, but not only in China. It could also have ramifications towards emerging markets and in particular Latin America. So what we're showing here is a 10% increase in building activity, and how will that affect Chinese GDP, and we expect a positive effect in activity, but also in the equity market. Now, we've split Chinese equities into A shares and offshore shares. Now, notice that offshore shares are those traded outside of China in foreign exchanges. And what you notice is that the dynamics is very different from local equities. Now, the reason for this is not necessarily the overall impact, but the dynamics in time. So because domestic shares are going to have a direct impact, you're going to see that the effect, the 3.2% increase, will be pretty much direct. Now, for offshore shares, what you're going to see is that it's going to take a little bit more. In the first 6 months, you're going to see much reaction. You'll likely see it from month 6 and 12 onwards. For Latin America, what it's interesting is, as you have places like Brazil, Chile, and Peru, which are copper exporters, iron ore exporters, you're going to see an incredible upside for those countries. Again, there's going to be a delayed effect. The first 6 months, you're going to see an interesting rebound, and then on month 6 to 12, you're going to see an additional bump. Now, what is perhaps interesting as well is that there's also positive effects from valuations. Now, we've noticed, and we explained this in the past in other webinars, Latin America has been one of the regions that hiked the most out of all of the regions, which had a detrimental effect in terms of valuations, which are sensitive to interest rates. Now, what we're showing here is real short-term rates, which is basically policy rates minus inflation, for Latin America, emerging Asia, which includes China, by the way, and developed markets. And what we can see from this chart straightforward is that Latin America has pushed their interest rates far above their historical average. And you can see within Latin America, there's different cases, particularly Brazil has been one of those cases where they hiked tremendously. They're above 13% in terms of policy rates, and they had a massive success in lowering their inflation levels closer to their target. And that even if it has some sort of drag in terms of earnings, we think that the effect in valuations from the beginning of the easing cycle in the second half of the year should improve the situation and the upside for Latin American economies. But even within Latin American economies, we feel that not all economies are the same. And I'll explain this now. I mentioned there's some upside in Brazil. There's probably some upside in Peru and Chile as well because of copper exports in the case that we see a Chinese recovery in real estate. But in the case of Mexico, we feel like it's the opposite. Because Mexican equity cycle is so close to the US cycle, we think that a downturn in manufacturing in the US would have a negative impact in the Mexican equity cycle. Now, what we're showing here is ISM new manufacturing orders with a 6-month lead. And we've noticed that in the past, there's a high correlation between new orders in the US and the Mexican equity cycle. Now, a fair enough question would be, why, if that is the case, Mexican equities haven't had a drop yet and they've been doing fairly well this year? Part of the reason is explained by these expectations of nearshoring towards the US. So countries are diversifying away from China and going into Mexico just to be closer to the US. And that is true. But overall, we believe when we're talking about Mexican equities, that the foreign direct investment that came in towards Mexico has been more than what we expect, and it's been more than what their fundamentals comprise. So in that context, we believe that the Mexican peso is now overvalued. So that brings a negative effect or a downside risk towards Mexican equities in dollars. And then on the other hand, if we do expect a manufacturing downturn in the US and negative growth or prices, we also have to expect a reversal in the Mexican equity cycle. And hence, even if we're bullish in Latin America, not all countries in Latin America are the same. Thank you very much.
Thank you very much, Tomas. We've got a few questions here. I think the best thing, because we've kind of passed the time allotted for this presentation, we've got two questions here. One being, if the U.S. Remains the place to be in DM, what style or sector should you invest in to gain alpha? And the second question is, what will make Japan sustain its revival on a long-term basis? What I'd like to do, because we've passed our time, we will answer these questions and send it to the attendees over the next day so that you get the answers. I'd like to thank everyone. I'd like to thank Tomas and Joaquin for your presentation, and I'd like to thank the attendees for listening in, and we wish you a great day.